You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music can mean but one thing. We are back. 'Tis Education Wednesday. The Options Education Force is upon you. My name is Mark Longo from theoptionsinsider.com, as well as from the Options Insider Radio Network. I will be one half of said force imposing the options education upon you this week. Of course, if you want more education, more information, just more options content in your life, first off, the easiest thing to do is just wherever you're listening to Bootcamp. If you're one of the few who's just listening to Bootcamp, man, step up your game. Get over there to wherever you're listening to this, whatever platform. It's available on all of them. And then jump up to the network. You'll get Options Playbook Radio, very much a sister program to this one. So if you're not listening to that one, man, you're screwing up in life. Let me just put it that way. Put it mildly. And then, of course, you get double episodes of the Option Block. You get Vol Views on Friday. You get This Week in Futures options. You get the crypto rundown, a whole bunch of other fun stuff going on throughout there. Then if that's not enough for you, you want more in your life, you want, let's say, a pro Q&A session like we have coming up immediately after this show with the one, the only, the Uncle Mike Tusaw, answering all your questions about option strategy and education. Again, very education-oriented. And then, of course, you want unusual activity breakdowns, looking back at the crazy week of unusual activity. What are the insiders, the crazy money? What are they up to? Options oddities for you every Friday. Of course, if you want to get access to this show and everything else we do live throughout the week or whenever your schedule allows, of course, you also get access to the pro podcast feed that gets you everything. Then theoptionsinsider.com/pro is the place to go. And of course, if you're one of our many on-demand folks, then of course, all we ask is that you just keep rating and reviewing. It really does help, obviously, again, coming off. Every month this year so far has been kind of the biggest month ever in the history of our network, 15-plus year history. We go back a ways. And July, no slouch either there, coming in hot again. So we thank all of you who've been beating a path to our door out there. And obviously, a lot of you leaving reviews is helpful with that. Just like we have Ray SSPL. Looks like this one might be from iTunes. He says, 5 stars, one of the best. Thank you. I think we might say the best, but hey, you know, who are we to quibble with your praise? Thank you. He says, one of the best. He says, top shelf information shared by Mark, Dan, and crew. Help me continue to step up my game. I'm subscribed to all of the Options Network podcasts. Well, thank you. 5 out of 5, exclamation point, exclamation point, exclamation point. Well, we thank you, Ray SSPL. And joining me to bask in that reflected glow, the other half of said Options Education Force joining me on the program today. The other guy who's named in that review, none other than the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring, what the cool kids call Umtum. Welcome back to the show, A, Mr. P. And B, what do you think of Ray SSPL sharing that 5-star love goodness?
Well, Ray, that is very kind of you. And thanks, because you know what? Like, honestly, that is the stuff that legit keeps me and Mark going. We do this because we have a passion for it. And we're glad that it doesn't fall on deaf ears. And we're glad to make some positive changes here in our little community we call the option trading community.
the passion for education and also the gobs of money. That also keeps us going, right? The passion and the heaping helpings of fame and fortune, right, Mr. Dan? Those all go side by side. But we like the love too. Thank you. Speaking of the love, let's see what you guys got on your brain this week. It's another all you guys edition. You guys get to dictate where the show goes this week. So let's break out the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. You guys know what comes next. You guys unleash your questions, your comments, your insights upon us. And Don, that's our guest from Pro Q&A from a few weeks ago, Mr. Don Schlesinger. No, Dan and I will take them on all sides, left and right, take on all comers. So come at us. See what you got. All right, let's start off. Speaking of seeing what they got, Mr. Dan's always got an ace up his sleeve for this segment. We call it Dan's Question of the Week. We might need a little drop for that, too. That'd be kind of fun. We'll work on that. In the meantime, Mr. Dan, what you got for us Question of the Week style, sir?
Well, I'll tell you what. I was just doing a one-on-one coaching session with a gentleman right before this. I hung up with him and answered this call. And he's a really smart guy. He's a good trader. And he's been getting into futures a little bit, but wants to get into futures options. He's like, hey, come on, let's take a look at an E-mini future trade. And I'm like, okay, to be fair, I don't trade a lot of futures options myself. I mean, I have professionally in the past, but these days I stick mostly to securities options. What are some of the nuances that I have to know about to trade futures options? So I guess that's the sort of amalgamated question that came up through our 1 hour one-on-one coaching session. And on the surface, it's kind of identical. Like E-minis versus SPY versus SPX. There's a sizing difference for all of those, but delta is delta, theta is theta, gamma is gamma, vega is vega. Where the difference comes in is really just the nuances. When we're talking about futures options, you have to understand what they settle into. Do they settle into the underlying future, which many of them that trade at the commodities exchanges do? VIX options don't settle into the futures, but we use the future price as a proxy for the underlying price. And it's not always very clear to see that. Like November corn, for example, doesn't expire into November futures. They expire into December futures. There's just these tricky little nuances. Also, we want to know what the tick size is. We don't want somebody to put on a 5 lot and be like, holy crap, how did I lose $10,000? I thought it was just a wimpy little 5 lot. Well, if the tick size is really big, you might stand to make or lose more than you think. It's very easy with securities options because it's I think it's always a penny, right? So, first of all, deciding, do I want to trade futures options? I looking at E-minis versus SPX and SPY, and E-minis had much wider options, bid-ask spreads. It was only about 2% wide between the bid and the ask, but it was wider than SPX and SPY. So there's less liquidity. Do I have a reason for trading them? And if you do, and if it's something you want to do, if you get down those nuances, just these little subtle things that make them different from spiders, you can give yourself an edge. And if you don't get those things down, you're going to be trading at a disadvantage. So it's a fun conversation. We just really went into a whole little banter for an hour just on the similarities and differences and pros and cons. So I just thought that would be a fun. I don't think that's something we ever talked about on boot camp. So I just thought it'd be a fun thing to kind of throw out there.
I like it. Since you had those little notifications pop in, let me just jump to this one from this question coming in from YouTube. By the way, a lot of you like to listen on show on YouTube. Hey, go for it. We love you out there as well. Obviously, it's not a video show, it's an audio show, but we put a nice little static image up there. So, a lot of people pretty much just listen to YouTube anyway. So we're down for that if you guys are down for that. Scott Somer asking on our, I think a couple episodes back, Dan, episode 186, it's time for a time spread refresher. He wanted to know, was that background sound at 17 minutes and 38 seconds? Was that a Tastyworks, Phil? He wants to know if you're trading on Tastyworks, what those sounds are, sir.
No, I'm pretty sure that it's the same sound as when I get alerts for Options Raider. So I'm not currently on Tastyworks. I'm on Thinkorswim. So my ding is, I guess, different than Tastyworks. I haven't tried out that platform yet, unfortunately. So yeah, you either heard a Thinkorswim, Phil, or you heard an Options Raider alert.
Dan's got a different ding, a ding differential here. Since he sent that in, that was his question, I guess. He also has a comment. I'll let him throw a twofer in because he's a regular listener, chimes in all the time. He says, Scott, we got to see you in the live one of these days. It'll be fun. You're missing out on all this fun pro Q&A action. He also wanted to know on that same episode, because we were talking about it's time for a time spread refresher. He chimes in to say, he says, yes, you want, quote, in non-earning cycles, quote, you want to have term backwardation. All right. So what he's saying there is if you're doing time spreads, listeners, effectively, if let's say in your typical example, you're going out, let's say 2 months, you're buying the 2 month out contract and then you're selling the front month contract. What he's saying is that in that environment outside of earnings, you want to have a little bit of backwardation juice because you're selling the narrow dated contract. And backwardation, of course, means the front portion of that term structure is going to be a little bit pricier, a little bit more expensive than if you go a little bit farther out. So what he's saying is in that environment, yeah, you actually can get some decent levels for a time spread there. So Dan, what are your thoughts on Scott's addition here that outside of earnings cycles, when you're doing time spreads, you want to try to find a backward term structure if possible?
Whether you're in earnings or not, I always want the option that I'm selling to be a higher volatility than the option I'm buying, whether or not it's during earnings or not. Like I think a lot of the listeners trade our total earnings nomination system, which is our earnings time spread system. One of the criteria are to sell the front expiration much higher than the back expiration. And, there's a bit more to it. Don't just jump in and do only that. Like there's other things you got to look at too. But I do that also. And for total earnings nomination, that's because we're looking for the crush of the front volatility. That's weighed against many other factors. But like we want to see that super high juicy vol and sell it and buy it back way cheaper. But we also want that with regular time spreads too, because that's what gets us an edge. If we're selling a higher volatility than we're buying and there's not a reason for it, there's not earnings, that just means that the front is overpriced relative to the back, which basically means we get a higher theta juice on that. And that's very, very attractive.
Very attractive indeed. Not always the easiest thing to find. You got to be a little bit judicious there, but intriguing stuff. Good points. And I like your little question about Dan's dings. We had Dan's question of the week. Now it's time for the big dog question of the week, which is the one, of course, we post out every week over there on Twitter at Options. This is a rare week. We actually have a twofer, a double question of the week. We don't usually do that, but it seems like the environment merited it. So we'll start off with the first one. Then we'll get into the big boy, the beefy one, Dan, that everyone's sinking their teeth into right now. First off, we asked you, start of the week, volatility has many different causes. However, which of the following factors do you feel is the primary driver of the current volatility environment? Gave you three choices and then the infamous other. By the way, you guys are dropping the ball on the other, but I'll get to that in a minute. Our choices are earnings season, the Fed, Ukraine, or other. And then it says, explain yourself. You have to say what your other is. And unfortunately, a substantial amount of you are choosing other, and you're not putting what your other is. That's what we want to know. You want to know what your other is. But Mr. Dan, what are your thoughts? What is the primary driver? Or perhaps you have an other. And then what do you think our audience is voting for?
Well, for me, I would say that the primary driver is the CPI and PPI figures every month. That's clearly the most important thing. That's the linchpin in this whole in everything, because if the only reason that the Fed would raise interest rates is to fight inflation. It's not staving off anymore. It's already an enemy. It's already rampant. And that's the biggest number. Everything else are factors that go into the equation. But if 2 months from now, PPI and CPI are down around 2%, which obviously is not going to happen, then holy cow, then the market rallies super hard and the Fed says we're not going to raise interest rates anymore and blah, 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 blah. So yeah, explain yourself, inflation is definitely the key driver, I would say.
I kind of lump inflation in with the Fed, but if you want to break it out, make it your own. Is that what you think our audience is voting for too, other?
Well, yeah, I mean, it's true that inflation is lumped in with the Fed. So I would think they would say that, but I think it's important to break it out because it's kind of like California is the 5th largest economy in the world, but they're part of the United States, right? The inflation figures, even though they fall within this lump of, what the Fed does, I think it needs to be broken out.
Well, maybe we should have done that because right now we got 0% of you voting for Ukraine, not a single fraction of a percent. That seems weird. Maybe we should have swapped inflation in there, even though you could argue that it is part of the Fed. Then we have 11.1% of you choosing earnings season. We are, of course, in the middle of earnings season right now. And then we have 27.8% of you, like I said, choosing other, but most of you not giving us what your other is. At least Dan gave us his other. And then 61.1% of you choosing the big beast that is the Fed. I'm assuming inflation, part of that equation there, but perhaps you break it out like Mr. Dan does as well. Now let's get to the big boy, Dan, the big mama, the one that everyone's chomping away at, the one I'm thinking you're probably going to have some thoughts on as well. This kind of came up after we were just actually in the middle of our option block show earlier this week on Monday, where it seemed like so much meme stuff was going on and meme paper was kind of flocking back in and people were asking about it again. And we were seeing call paper. So we thought maybe it was time for a rare second question of the week. And this week's second question of the week is, we've seen an explosion of call options paper in names like GameStop and AMC and Vroom and Be Big and Bed Bath & Beyond recently, which raises the question, is the meme stock frenzy back? We made this one very simple, very straightforward, just a simple yes or no. Mr. Dan, what are you feeling? What do you think our audience is feeling?
Yeah, so I've got some things to say about this. I think, clearly right now it's back. It never really went away, but there was a little bit of some dormancy there. And it's because the markets were down. And it's a little bit illogical, to tell you the truth. It shouldn't matter if the market is up or down for these meme stocks for a short squeeze to happen. But there's a lot of psychology that comes into trading markets. And when people are like, hey, all my other trades are making money, I'm happy, this is great, I'm good. Well, yeah, let's throw a bunch of money at these calls in VRM and try and get a squeeze going. There's just, it's psychological and it shouldn't be. It shouldn't matter. But because the market has been up, that's why we've been seeing this. And I suspect that the market could head up a bit in the short term. It's probably going to have a pullback at some point, whether that's next week or next month or next quarter. And we'll see the meme stocks lull again, but the market goes up over time. And so it's always going to be a play. Even if the Redditors sort of forget about it, short squeezes are always going to be a play. There's times where they're hotter, times where they're cooler, but it's a perennial trade.
The perennial trade. And Mr. Dan, seems like our audience agrees with you overwhelmingly, 74.7% saying yes, only 25.3% saying no. So Dan, our audience agrees with you. They said the memes are back, sir. So we are in meme town again. I guess we are starting to see, like I said, that flow come back and went away for a while. We didn't see the massive 10,000 lots of crazy weekly out of the money calls going up at 150 vol like we saw pretty much all of last year. It was mostly puts for the first half of this year, but we are starting to see some of that peppered back in there again. And with things like Coinbase pretty much doubling overnight, who can blame some people out there? Crazy times afoot. At Options is the place to go to make your voice heard. We got a little bit of time left out there, listeners. Let's get on out. By the way, last week's one, we asked you guys about the artist formerly known as Facebook. We said it's struggling. The stock was down on 50% of the year. At the time, was currently trading on 163. If you had to purchase an at-the-money call or put on that bad boy, which way would you go? And you folks were fading Facebook pretty hard. I don't have the exact numbers here for some reason. Nearly 50% of you, though, were going up on the dark side for Facebook, saying no love. Here we go. 48.3% of you saying you buy that put, look out below. Only 28.3% want to buy the call, and 23.3% said, I'm done with Meta. I actually kind of thought maybe that number might be higher. Let's go back to the live. Nichols says, good luck finding that backwards term structure. Yeah, what Scott was referencing earlier about when you want to trade time spreads, you want to have a backward term structure. Yeah, it's not there all the time. It's something that's a little bit difficult to find. You got to be judicious with these time spreads. You can't just go swinging them willy-nilly everywhere. You have to have the right setup. So, yeah, it's worth noting. It does take a little bit of effort, but anything worth doing is worth doing right there, Mr. Nichols. Let's go out to DVD. DVD, I like to handle DVD. Maybe a little bit behind the times. Is your other handle Beta, Max? Maybe? Who knows? But I like it nonetheless. Old school tech. He says, hey, guys, new listener alert. Well, welcome, DVD. You're one of the many hordes joining the show these days. He says, I found the discussion of second-order Greeks particularly interesting since I hadn't heard that term before. You also referred to gamma as a second-order Greek. I've only known it as one of the, quote, Greeks. What distinguishes it as a second-order Greek, but not delta or the rest? So interesting question. This was a couple episodes ago, Dan, you and I were talking about second-order Greeks, which is something, by the way, listeners, as I mentioned on that episode too, we have discussed full episodes of, we have devoted entire episodes to in the archives of this show. So if you're new like DVD here, go scrolling through the archives. It's a couple hundred episodes, and I get it, it's a lot. But you'll see some titles there that say second-order Greeks right in them. So if you want to dive right in, if you are a little bit confused by the concept. But Dan, we were talking about the Greeks, and we were pointing out the fact that gamma, even though it is one of the big ones, the big main Greeks everyone talks about, is actually a second-order Greek. DVD is confused. Why is that the case, Mr. Dan?
Yeah, so, I mean, no need to get super hung up on labels or anything, right? The subtle difference, or I guess the defining difference, is that, like, first-order Greeks would be relative to the primary mover, right? So, like, if we're talking about delta, if the stock goes up by X, the option goes up by Y, right? And by primary mover, I guess I mean inputs into the options pricing model. So stock price changing, time changing, volatility changing, interest rate changing. So where gamma comes in is, it's not if one of those things, those primary things, stock price, time, volatility, interest rate, it's second order because it's relative to delta, right? If the stock price changes, how much does the delta change, right? Not how much does the options price change, which is like a direct relationship between the primary mover and the options price. It's how much does this other thing change? I guess I kind of phrased that a little bit incorrectly. It's the primary mover, but it's relative to not the option. It's relative to the delta, to this other thing. And, you know, as far as secondary goes too, we, like, for all the math nerds out there, wish I could include myself in that group. So definitely not hating on anybody. It's pure envy. But for all the math nerds out there, it's like second derivative is really the best way to think about it. If delta is the first derivative of a graph between, if the stock price changes by this much, how much does the option price changes? You know, if you look at that curved line, delta would be that derivative, but gamma would be the second derivative of that.
Dan, slinging some more trades on Tasty. What'd you buy, sir? What'd you sell?
No, I just got an alert. What was it here? Let's see. What was that alert?
Those are always going to be the Tasty Works dings now on the show. They should get, we not sponsor anything. We get no money from them. It just blame our listeners. Speaking of our listeners here, we've got Unlimited in our chat reminding us, hey, VIX just broke 20. And yes, you are correct. We are once again, as we're recording this, listeners, in kind of rally ho mode again in the markets. Apparently, if you haven't got the memo, all is right with the world. Get in there and buy this market with both hands. 4,200 now in the S&P, up nearly 2% again on the day. So we have NASDAQ close to exiting its bear market here at this level. So yeah, S&P up. We got it down to around the 3,600 and change levels, up nearly 600 handles from those lows. So that's quite a rebound out there. Is it here to stay? That's the question I think everyone's wondering out there right now. But yeah, as a result, VIX has kind of been languishing for a while. If you listen to our Vol View show, you know that's the case. We've been talking about that for a while. But 1960 right now or so in VIX cash. So below the 20 handle. Not looking good for my prognostication. But as we all know, the vol market is fickle. By the time we get to Friday's show, anything could happen out there. But a good point there. I mean, you finally below 20. Any of you out there rocking some VIX puts? I know it's been kind of a sleepy game for a while, so maybe some of you got shaken out of it. But if you got some in your back pocket today, maybe a decent one for a rainy VIX day like today. Let's get on out to Twitter. Jason Cruz, he's written in before. That name sounds familiar. He says, from the credit spread episode of Options Bootcamp, just the one we just did, Dan, about the family-friendly version, how not to F up your credit spreads, for lack of a better word. He wants to know, when I sell a spread one or more standard deviations out of the money and outside of support levels, what are the market makers doing with that junk long spread on the other side? So yeah, you come in, we're talking about our credit spreads, and you decide to blast away on some kind of nonsensical garbage, very far out of the money, Dan, over one standard deviation out of the money. He wants to know, what do the market makers end up doing with that junk long spreads?
Well, they probably laugh at you for putting on such a bad risk reward. I mean, hey, man, like when I put on a credit spread, I definitely look to see, hey, where can I want to sell it as far away from the money as possible. But I mean, you get to a point where the risk reward just not worth it, where you stand to make like a nickel and you can lose, $1.95 or something. And it's just silly. Like a black swan event happens and like you get annihilated. So I don't know. And plus you got to think about it too. Market makers, like those trades, like especially if you put it in mid-market, they get to sit there and pick and choose and say, okay, so this guy wants to buy the 70s from me and sell me the 75s. I actually need to buy the 75s. Oh, and I need to sell the 70s. Oh, actually, I'm taking off risk with this trade. Yeah, okay, I'll do it. I'll even do it at fair market value, mid-market. So, market makers are always trying to get out of risk as much as they can. They're definitely not excited about putting on a trade like that. But if it fits them to get out, yeah, why not?
Yeah, well, first off, for the majority of our audience doing probably 10 lots around that level, the market maker's not sweating the 10 lot on the other side. They have so much inventory they're sitting on. Your 10 lot is kind of just lost in the ether. If you were some large institutional customer doing maybe 10,000, that's a little bit of a different story. Or if maybe a large amount of retail are deciding to do these far out of the money spreads, and that's maybe a little bit of a different story that could start playing with their risk scenarios. But really, at the end of the day, they have tons of inventory. Yours is kind of just going into the mix, and they're really just looking at things from a net strike perspective. When we were out there managing our positions on the trading floor, you weren't saying, hey, do I have a credit spread here? You're saying, hey, what's my position on, let's say, the 70 strike? Oh, I'm long, 1,000 here, or maybe in the case of these days, 10,000, more. And then, I'm short 8,000 on this strike. So that could line up easily with their inventory. It could reinforce what they already have on with their inventory. But they're managing stuff on a strike, very sizable basis. I doubt your trade is going to tip the scales, Jason, but it is an interesting, I guess, theoretical question. And if it's something really outside the norm, some size institutional play, then yeah, they'll have to price it up that way. You'll see the spread reflecting the extra risk these guys are taking on because they're going to be wearing it for a while. But outside of that, that's why they're willing to step up to do your 10 lot, because it's not really going to move the needle that much. Theodore Domzalski, another name that sounds familiar. I believe he used to be our food guy on the show. He says, I know you only take questions from the elite these days. Well, first off, that's a lie, Ted. You know that's not true. We take questions from everybody. We're taking your question right now. Maybe you're elite. I don't know. But we take questions from all comers here. You don't have to just be in the live chat or the pro to ask questions. That's only for our pro Q&As, where that's literally in the title. That's for our pro listeners. But outside of that, all of our shows, we take on all comers. He says, is it possible for the retail trader to sell a SPY strangle and delta hedge with shares and make money? Short answer is really no. Longer answer, Ted, because you sent this in a little while ago, and Dan was traveling, I was traveling, so we had some episodes that we had recorded that were in the can. So I knew it was going to take a while to get to your question. So I made sure we actually answered it on actually a show that is more appropriate for this conversation, which is Volatility Views. So if you go back to our most recent episode of Volatility Views, you will see and hear that we already answered this question there. But I will give you the short answer right now. These days, in a retail account with the various margin issues and everything else along those lines, this has always been a challenging trade anyway. I mean, think about it. You're short a strangle, and then now you're trying to delta hedge. So as you're moving around, you're buying underlying, you're selling underlying. It's a very capital margin intensive trade, which is automatically going to price out most retail people in there. So difficult. You can do it, but it is very difficult. If you want the longer answer to that question, Ted, check out Volatility Views, which all of you should be doing. You should all be subscribed to the full network. Anyway, same deal here for what we got here. Well, first off, Dan, if you have anything to add really quickly on, because he did send it into this show, on a retail trader trying to sell short strangles or straddles and delta hedge them, is that a profitable long-term trading style for a retail trader, sir?
Yeah, the answer is definitely probably not. If you have Reg T margining, certainly not. It'd be ridiculous because you have to tie up a whole bunch of capital to make very small amounts. So you have to do a massive leverage, which you can only do with retail portfolio margining, but it's still hard like that. You also want to be putting these on, if not mid-market, like better than mid-market, like selling above mid-market, which is almost impossible. And I've trained people to do the other side of this. I've trained people to gamma scalp long straddles and strangles or synthetic straddles and strangles. And I trained 3 retail traders in my life to do it. And they like the criterion was you got to be really smart. Like you've got to be a very good trader. And so all 3 of them were great traders, and I couldn't make it work with any of them. So it's not a trade that's set up for retail traders.
No, we used to do it all the time, obviously on the trading floor, but that was kind of the game. That was what we did. Going back to the other question about net inventory, we would always have usually either long gamma or short gamma, and you were hedging it one way or the other. And that was kind of a lot of what we did on the trading floor. But we had very different accounts, very different size and capitalization, very different margin. A lot of very different things that just aren't present in a retail account, even with all the advancements we've made today. So yeah, I would stay clear of this trade. It's difficult even for pros, quite frankly, let alone all the retail disadvantages you have. Let's see. Let's go out to this question here from Charting Monkey, a.k.a. Theta Noob. He's got 2 handles. I like both of them. I like Theta Noob probably a little bit better. He says, hello, Mark and Dan. First of all, thank you for everything you guys have done for the trading community. I honestly don't think I would still be here trading if it wasn't for the efforts you guys put in every day. Well, we appreciate that there, Theta Noob, a.k.a. Charting Monkey. We try to make sure you guys have a good experience and can stay in the options game a long time and be profitable over the long time. That's kind of the focus of the show at the end of the day, is keeping you guys in the game for the long haul, not coming in, flash in the pan. Everyone's hot with Robinhood, slinging one lots, buying crazy meme stocks, and you blow out and you move on to the next thing. That's not what we want here. We want you guys to come in, become informed, educated, successful over the long term options trader. That's better for everybody. And that's what we want here. So we're glad we could help out there, Theta Noob. This guy goes back, actually, Dan. He says, I was disappointed when you guys stopped the Options Bootcamp podcast for a minute, but by the time I finished the archive of episodes, I was glad to hear you guys restarted the podcast on a consistent basis. Yeah, we took a little bit of a hiatus there for a variety of reasons. I was busy, Dan was busy, and the other things were going on, behind the scenes. But you're right. A lot of people like you, Theta Noob, really missed it, really wanted it to come back. So I'm glad to hear you were able to satiate yourself with the archives, which are substantial for this show. And by the time you got through them, hey, we were back. It wasn't that long of a hiatus. So yeah, we are back consistently now. Glad you're enjoying it. Because I've been trading for 2 years, and I have slowly progressed into futures and options on futures. I have a question that I've spent a good amount of time searching for an answer, and to ensure I'm not oversimplifying the concept, I would like to ask for your expertise and guidance. I understand this question may not align with the scope of this podcast. If so, please direct me to the podcast that I can download to listen to for an answer. All right. Yeah, I remember this now. Yes. Okay. You sent in a very epic treatise on effectively trading the micro E-minis and doing a covered call on a one-lot micro E-mini futures options contract. Is it approximately the same as a covered call, I should say, on 100 shares of SPY, except for the notional value difference, margin requirement, assignment difference, and product settlement? Much appreciated. This is another one that came in during that period where Dan and I were kind of moving around and traveling. We had a couple of shows already recorded. So I hate to have you folks waiting. Plus, so it's actually more suitable to another show. So we did answer this actually a few weeks ago on This Week in Futures Options. Hopefully you caught it. If not, it was episode 310 called No Market for the Timid. It was myself and Todd Colvin from Ambrosino Brothers. It was a perfect guest to kind of dive into this topic in a little bit more detail. It was an epic question, but intriguing stuff. So that happens. Sometimes you guys send in a lot of questions. Sometimes if you guys send in something that is better for perhaps another show, or perhaps it's a time when we're not going to be able to get to it in a reasonable amount of time, we do try to make sure you are answered somewhere else. No one goes without an answer here on the network, in spite of what Ted says that we only answer the elites. We try to answer you all. So if you're missing on your answer here, for some reason you say, hey, you didn't answer my question, check out some of our other shows that might be a little bit more appropriate, or we'll try to inform you whenever that situation arises. Great questions, though, there. Everybody, you guys brought it this week. All right, so there we go, listeners. Not only are we answering your questions here on the show every week, but when we can't get to you, we send you to other shows to get your answers. So you're always getting your answers. So keep those questions coming. Of course, questions at the Options Insider, at Options on most of the major social media platforms. Or if you want to be one of the cool kids, join the secret club. You get bumped to the top of the list for your questions. Also, you have that members hotline to bump your questions to the top of the list. And also, you get access to our Pro Q&A, like the one coming up in about 20 minutes, which should be very fun. All you cool cats hanging out in the live chat. Just hang out. We'll be back in a little bit. But before we go, Mr. Dan, if folks have questions of their own, they want to come at you, like some of our listeners on the show today, where should they go? What should they do?
You guys know where to find me. Make your way on over to markettaker.com and hit me up, man. Join our community for free. Send me a question. We're actually accepting one-on-one coaching applications right now. You can scroll down to the bottom and just hit the application in the footer of our website. We'd love to talk to you. We have our trader success team give you a call and see if you're a good fit. If you're not, no worries. And if you are, then maybe we can help move you ahead faster and farther.
There you go, markettaker.com, what the cool kids call to Don't you have those masterminds coming up soon too, sir?
Yeah, we've got the mastermind in Chicago at the SIBO next week. Excited about that. Are you going to make a showing?
Is it next week? I didn't know what the date was. Oh, yeah, send me the details. I'll try to swing by and grace you with my presence, sir. How does that sound?
That would be wonderful, man. Oh, that reminds me. We should, well, I'll email you. But I think we're going to have to reschedule Wednesday's boot camp.
Uh-oh, you got action next week. That when the mastermind is?
Yeah.
You're masterminding during our show?
It is Wednesday, Thursday, and Friday of next week.
Oh, okay. We might have to reschedule then. There you go, listeners. Blame Dan. See, I knew something was afoot coming up next week. I could just sense it in my bones. In fact, we have a listener, someone just recently asked if we can do a show from the VIX pit at the SIBO. It's like, I don't know if that's going to happen. The new one. He wants the new VIX pit. He wants us down there doing, I think, vol views. I'm not sure that one's going to happen anytime soon. I think the traders in the crowd might have something to say about that. Might be a little distracting. Intriguing stuff there, nonetheless. Keep those questions coming. For all of you who have more questions, if you haven't got your questions in for today's Pro Q&A, start getting them in now. What are you waiting for? I know a bunch of you already have. Uncle Mike's always pretty popular there. We'll be back in about 18 minutes now, live with Uncle Mike to answer all of your questions from St. Charles Wealth Management. Then, of course, back a little bit later today with Mr. Overby. He'll be live to tape. He'll be hitting the network on demand a little bit later today. And then back tomorrow, of course, This Week in Futures Options and the Option Block episode due for the week. Friday, volatility views, and, of course, options oddities. Then back again next week. I guess we'll have to figure out what day we're doing it because we got to move it around. because of the mastermind, but we shall see what we're up to. Someday early next week, we shall do a next episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.